The growth of franchising in South Africa has been absolutely phenomenal, but it's also a sector with plenty of untapped potential. Finweek journalist Blair Burmeister takes a bite out of fast food franchising to bring you the best investment bets. Could there be a sizzling opportunity there for you? Simone Cooper, head of franchising and enterprise development at Standard Bank, and Derek Smith, chairman of the Franchising Association of South Africa and the joint managing director of the Hot Dog Cafe franchise, joins us in studio. Thank you everyone for joining in this conversation. Derek, I'm going to throw this first question at you. Why are we seeing such an increased appetite for the franchising model in South Africa?
I think franchising is probably a very safe way of getting into business for the first time. The success ratio, well, it shows that, I think Rob Davies said the other day, that 5 out of 7 standalone SMEs don't even make it past the first year. But in franchising, it's the reciprocal. 90% of franchise outlets are still existing after 2 years. So I think people are, especially those getting into business for the first time, are saying this is a much safer route. You have support and protection.
Simone, would you concur with those sentiments? And particularly, I want to throw the question of whether entrepreneurs generally have a good understanding of what they're getting into when they try to adopt the franchising model. Is there a general understanding of what it takes to make it work?
Sure, it varies. There are some people who come in extremely prepared and they really have done their homework, they've researched the brand, researched what can be done for them. But there are other guys who also come in not researching anything, taking the first opportunity that comes along, and they really start to burn their fingers.
Of course, I'm sure, Mark, you have something to add there, but before you do, I want to throw in just a little curveball, because we've seen that the franchising model has been rather resilient, even in tough economic times.
Sure.
And I'm sure there's specific reasons for that. And maybe if I ask you, Derek, to share first, and if Simone, you've got additions, and then we'll come back to Mark.
Sure.
Well, again, you know, going through, we have a proven business model. We have strong brand strengths within those models. If you think of a Steers, a Debonair's, a Shell, a BP, you know, people trust those brands and they tend to buy from them. But you've also got a very strong support structure in your franchisor who's capable of sourcing product, because he can buy in bulk for large franchises. He can source the best costs, national marketing campaigns. It's all a matter of running really a big corporation through small SMEs to the joint benefit. And I think that's probably why we've seen the resilience.
From our perspective, it's really about the support that the brand provides. So generally, you've got people going into business, they don't have the skills, they haven't been in it before. It's a very daunting place to be all on your own. And with the support of a franchisor, you can really start to eliminate some of those risks. They help with financial management, all of the things that generally small businesses struggle with. So it's definitely a great opportunity for a small business owner.
Okay, but then you talk about them coming in and without experience and simply adopting the franchise model. Doesn't that still present risk, though, that if somebody hasn't actually tried to run a business before, they haven't burnt their fingers, they haven't got any kind of track record to look at, does it not worry you that you're taking on somebody? I understand the benefits, but does it not worry you from an experience perspective? Or maybe turn the question around, is it still important? You can't just assume that if I walk out of here today and say, great, I'm going to start a Steers franchise, does that make me any more capable of running the business than if I hadn't picked a Steers franchise or something existing?
Yeah, we generally work very, very closely with the franchisors themselves. So we're looking at very, very strong brands that are making sure that they're picking the right candidates and that they're also providing the right training. So there are a lot of brands out there who aren't necessarily doing the right training, who aren't providing the right systems and processes. So we generally take a steer from the work that we do on the franchisor itself and understand their systems and processes. So they will send guys through very long training programs, they will accredit them. So by the time we're seeing the guys that are coming through, they generally have been screened for general business acumen, and there's a lot of things that will make it more successful than just a normal startup.
Yeah.
There is also the point, you've got a proven business system. You actually don't want franchisees that change and mess around with that system. So in a way, someone who's not been in business before is like a fresh piece of paper.
Sure.
And they won't mess with the system as easily.
I suppose one thing I want to throw back to you again. So, I mean, we've seen, for instance, Rhapsodies in the news recently, and this is the kind of thing that worries a lot of people when they hear the franchising thing. And you know, there's a lot of a glamour factor to running a restaurant of the Rhapsodies nature. But the systems weren't in place there, and yet you've had a situation where a lot of people have been led to believe that these systems are there and the financial controls are in place. Basically working on what's in the media at the moment, those controls weren't there. How do you turn it around from the perspective of both the lender and the potential franchisee? How do they know that they're getting into a proven business model where they do have what they claim to have?
Yeah, so we encourage all of our clients to do their own homework. So we've obviously done a host of homework on the brands themselves. There are instances where you might not pick it up. So, from what I understand from the Rhapsody's case, from what's been reported in the media, it's a case of there's quite a lot of fraud involved, which you might not necessarily pick up from doing your homework. So there could have been things, but there generally are warning signs. So it might be rosy when you get in, but there generally are warning signs that things are deteriorating. So it's about being aware and constantly communicating with the franchisor and checking that things are what you thought they were, and seeing how things go from there.
Mark, if I might add to that, I know a little bit about the Rhapsody's case, and there the actual operating units are pretty viable,
right.
As much as any franchise. There is allegations of serious fraud. Now you can write a law saying thou shalt not murder, but it doesn't stop people killing people. And similarly, if a guy is going to break the law and defraud people, that's beyond setting the rules.
Fair enough.
And I think that's where one of the problems. There was a bit of naivety, I think, as well, is that when it was suggested that the systems be broken, the franchisees went along with it by trusting the particular gentleman. So I think it was more a fraudulent problem than it was a systems problem.
Fair enough. I guess one of the other things that then comes in is a lot of capital. Franchises tend to be quite capital intensive, particularly when you look in the fast food space. I know that there are some of the smaller ones, but typically, you can be looking $500,000 to $1 million just to get your foot in the door. How much of that unencumbered should be an unencumbered capital that when you're looking at it from a lender's perspective?
From a lending perspective, we generally take our steer from the franchisor themselves. So they generally or typically are looking for 40 to 60% unencumbered capital that comes in.
Right.
So we will, if it is a first-time store owner, so somebody who's coming into franchising for the first time or has got other businesses and this is their first one, we would look towards those guidelines. There are instances where you might go lower than that if it's somebody who has got multiple businesses and multiple stores and they've built up a lot of equity in that. But we are generally guided by the franchisors. They've tested the models, they understand how much you can gear the business and how much you can't.
What about there seems to be the argument, whenever you talk to the franchisors themselves, they tend to talk about this owner-manager model where the owner's in the store the whole time, and maybe Derek can also give some input here as well. But then you talk to those that make a real success of it tend to operate multiple stores. So how do you guys view that from a risk perspective? Should the guy be sitting in his store, the store that he owns, and sitting on top of it the whole time? And how do you manage that from a risk perspective? And then I guess from an operational perspective, how do you manage that where you've got multiple franchise operations?
Do you want to go first?
All right. So from a risk perspective, obviously we encourage the owner-managed model. It means that the store owner's on site, he's got his finger on the pulse on what's going on. Particularly in retail and restaurant industries, there's a lot of theft if you're not on site. So if there's a first-time franchisee that we're looking at, we would generally look at someone to be owner-managed. However, once someone has made a success of one store, it is possible for them to expand into other stores. So we will look at how successful they've been, what controls and what systems they will put in place into the existing stores once they go and acquire new stores. So it's really, each case is assessed on its merits and each one is done individually. So you'll look at the entrepreneur themselves, the brand that they're within, what they've said, how successful they've made their existing stores. So it's really dependent on their previous history in that instance.
Okay. I think also there's personality. It doesn't matter whether it's franchising or it's any other form of corporation. You get certain guys that are very good at running one operation, but they're not very good at delegating to management to run 2 or 3 operations. I think that's a very important factor. It's the nature of the animal as well. Certain franchises lend themselves to be managed at more arm's length, some don't. I mean, for example, a Rhapsodies, you quoted Rhapsodies, that is a very complicated animal. It goes all the way from preparation of butchery meat through to processing, through to alcohol, through to, you need to be hands-on, you need to be in the store, that's for sure.
Derek, there's a very interesting trend that I want to pick on, and this is the collaboration that we're seeing between fuel franchises and retail franchises. You know, what are the benefits of going it that route?
Well, it's, in America, this has always been a big thing. It's maximising the space. They have the petrol stations have the foot traffic by its very nature, but it's also a convenience point. I mean, you know, traditionally we used to go to large centres like the Menlins of the world and things like that, but that's quite an effort. Whereas if you can pop down the road, call into your engine and go to a Woolworths at the same time on the way home and grab your supper, it's convenience. Now to the franchisee, it's just adding value. You know, I think margins on petrol are getting tighter, and they're looking for other forms and sources of income and just maximising the space.
Is it a less risky approach, Simone?
Well, certainly once you're maximising the space and you've got a convenience store and a quick service restaurant and the fuel site as well, it certainly means that you've got more income coming in. So from that perspective, it's definitely less risky. However, you have to have the right person in place so that they can manage all of those operations, because fuel and quick service and a convenience store are very different businesses.
I would like to look at the relationship between the franchisor and the franchisee. Obviously, it's a very long-term relationship, and I want to look at. I mean, I want to chat quickly about the control that I, as a franchisee, have over my store when there are things such as refurbishments, new look and feel and stuff like that. And if I, at the moment, I don't currently have the cash to do, to carry out such an exercise. How much control do I have as a store owner to say, actually, I just don't have the money to buy new couches, to get new cups or new glasses, fancier ones, etc., etc. Where and how do we reach a common ground in that respect?
Do you want to take this one?
I can understand the difficulties in that one. I mean, Christo Carlitz faced it when he revamped Wimpy. It was a magnificent thing. In fact, I chatted to him about it and I said, how did you do it? How did you persuade guys that were breaking even or losing money to reinvest another $500,000? And it's simple. What the franchisor did in that particular circumstance is it did a pilot store itself. It proved to increase profitability or turnover by 30%. And people are not silly. When they see that type of thing, they want part of it. It's necessary. I think a good franchisor will also come to understand a franchisee's problems, and although insist on the revamp, because you're only as strong in a brand as your weakest outlet, they might put it over time. They might do it more slowly. They might give terms. They might, there are ways to get through it. But revamps are generally there to improve profitability, to revitalise the brand, and to increase turnovers.
Is that something you would play a role in as a lender? Absolutely.
So we would look to finance a portion of the refurbishments, depending on the brand again, depending on the business itself. We'll see what sort of repayment ability there is, and we would definitely look at that.
Do you, Derek, do you get the sense that the franchisors are actually taking advantage of the franchisee? And it's a very general question, but you look at the situations like McDonald's at the moment, where they're actually getting huge pushback from their franchisees because they're being squeezed tighter and tighter. And times are tough at the moment. You look at Woolworths. They've been taking the stores back from it. It almost feels like the loyalty seems to be disappearing from the value chain in places.
I think there's two aspects to this. I think a franchise only works where both parties are making money or losing money equally or investing money equally, because it's a partnership. And the moment you swing the profitability to one side or the other, that franchise is doomed, in my opinion, because everybody's got to go home and be able to feed their families and make a living. I think with the McDonald's situation, you have an added complexity. Once you become a publicly listed company, then the pressures of the JSE come on your shoulders, and then you've got to produce quarter after quarter. And sometimes that may or may not, I'm not saying it did in that situation, it may just create some over-enthusiasm in ways of producing a quarterly profit. So it's a very good thing to be a quoted company in some instances, because you can raise cheaper money and grow. But it adds another strain to that relationship.
I think we've